Welcome everyone to our roundtable, The Return of Inflation, Out of the Frying Pan and Into the Fire. I'm Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence, and I'm joined by an extraordinary lineup of very illustrious panelists. If you'd like to learn more about the panelists, please visit their speaker bios on the forum portal page. We're going to jump right into it because we only have 45 minutes to discuss a pretty hefty topic. Nonetheless, I'd just like to throw a broad question out to our panelists to get started. Has the pandemic forever altered the demand and supply imbalances in the world economy? Are we entering a new inflation regime or not?
Well, Gina, I'll hop right in. I don't think so. I think we're seeing some transitory and temporary imbalances between supply and demand, some roadblocks or bottlenecks in supply chains, but those are rapidly going to be resolved. And some of the price pressures coming from them are likely to be transitory too. We're certainly seeing an increase in year-on-year inflation, which is largely expected. The question now is how much of that increase bleeds into a change in expectations, which could be the herald of a kind of regime change, and how much of the reopening of the service sectors in major economies provides a little more impulse into headline inflation as we move through this year and into early next year. So I don't think we're in a regime change, but there's a possibility at the edges that we could see this inflationary spike a little less transitory than we currently expect.
Gina, when you get a group of economists together, you've got to have someone take the other side of that. So let me take the other side. And I think the permanent angle on the new inflationary picture, the post-COVID inflation, comes from the huge amount of productivity increases coming in because of the adoption of technology, more flexible work environments, and the massive amount of investment that's gone on to boost productivity. I think that's going to show that the disinflationary forces that were in play before the COVID, the struggle the Fed had to meet 2% target, is something that's going to return to us because of that boost in productivity and the higher use of technology that going forward.
Yeah, and I'll jump right in there and say, to borrow from the Fed's term transitory, we are in a transition, I think, in terms of supply and demand, as you mentioned, especially in terms of the way supply chains work globally. And I think within that transition, obviously, we've lost some efficiencies. We have some imbalances. Probably an easy one to point to is this idea around the shortage of chips. And so I think as we work through to this kind of new way of doing business globally, then yeah, some of these disinflationary forces will come back into play. But as we are in transition, we will have transitory inflation.
What would change your mind as to whether or not it was transitory? At a certain point, if we still have, say, 4% inflation prints in a year, does that characterize a very different kind of inflation regime? Or, I think that this word transitory is very open to interpretation. How long is transitory, or how high does inflation need to get before the consensus view on transitory inflation really changes?
I think the key question is, does the price pressure that we're seeing in the economy today, does that broaden out? And so right now it seems to be concentrated, say, in supply chains for semiconductors, maybe with some reinforcement from commodity prices. But do we start to see that in other types of goods? And does it start passing through into higher wages? And if I were starting to see those things, I think I would say it feels more long-lived and less transitory. Whereas if it's mostly chips, it's going to be disruptive, it's going to be painful. But I think firms are learning how to manage the shock in real time. I think firms are learning how to manage their inventories better in real time. And I think we'll be able to work it through. But if this is a series of shocks as the economy adjusts back to whatever the normal post-pandemic is going to look like, then I think transitory is the wrong word to describe it.
So Gina, to also answer that question, what I would say is that I don't think supply chain bottlenecks are going to create any longer term inflation. However, I do worry about the labor market and the current level of labor scarcity that we're having. What we've heard and seen in the Federal Reserve Beige Book feedback from companies is that there are a number of reasons why employees are reluctant to return to work, from childcare issues to fear of COVID to public transportation schedules being limited. All those things, in my estimation, are very temporary in nature. But an important litmus test is going to be this fall when schools reopen, when presumably more Americans are vaccinated, so the COVID threat has gone down even further, when public transportation schedules are presumably more robust. That's when we'd want to see a larger pool of employees, and where we would see, I would expect a reduction in wage growth. We'll see, well, I should say we'll see wage growth, but it will be tempered somewhat in this environment because we'll have a more robust workforce. And that to me is going to be an important determinant of what we see for inflation, whether it's going to be stickier or more temporary. But what we've already seen is that companies are employing workarounds. They're talking about investing more in technology, for example, so they can hire fewer workers. So we'll want to follow that as well. But I have to say, so much of this really centers on the labor market. That's why Janet Yellen was laser focused on the labor market as Fed chair. She created a 19-point labor market conditions index. I wish we had it today, because I think that would be helpful as we assess the labor market and its potential to impact inflation over the longer term.
I agree that this is about the labor market, but I think this temporary thing is just not very useful. I find it vacuous. Like, we're going to go through some pandemic specific issues that are going to drive some inflation volatility. So, and we could talk about that. It's interesting, demand's recovering faster than supply now in services, and goods should come down, and how high is that going to go for a while? But this is going to end. And when it ends, are we going to go back to before? And when we go back to before, which before are we going back to? Because in 2017, 18, and 19, if you looked at the US labor market, we had pretty good wage growth for retail and leisure and hospitality and $15 an hour jobs. And if you go back to like the previous 20 years, really bad wage growth compared to the rest of the labor market. Something was happening structurally. And while I'm not convinced we're going to have strong macroeconomic broad wage growth across all sectors, I think we may in those sectors for demographic reasons, for underlying reasons that were becoming visible before the pandemic even began. And I wonder, given that those wages are the ones that tend to pass through into services prices in those sectors where prices are measurable and matter in the indices that we're really talking about, I wonder whether that could lift average inflation and give us a little bit more volatility inflation after the pandemic. And I think if that happens, that's pretty important. It sounds like I have a little bit more of an upbeat view on higher and more volatile inflation after the pandemic than maybe some other people do.
Mm-hmm. Let me echo. Go ahead, Elina.
No, I just wanted to jump in with emerging markets. We've focused squarely on DM, and it matters a lot. But emerging markets inflation, we have seen also what has been the before. We have seen a trend decline in emerging market inflation, very synchronized fashion, much less volatility than we've ever seen in the past. So what's happening now? If you look at the shock, the size of the shock compared to, say, global financial crisis, the response to inflation is just so much lower. The response of the inflation, import prices, PPI to CPI headline is much lower. Pass-through from effects to inflation is much lower. And I think what is at the core of this is inflation targeting credibility in many markets. We used to have maybe 10 inflation targeting central banks in EM. Now we have more than 40. And if you look at the share of those that are still within target, it's actually very high. It's 2/3 of them. At the same time, many already are hiking because they're responding to the high inflation expectations. So this preemptive action will also take an effect about the time when we might be actually coming off the peak on the commodity prices. So I think for emerging markets, it's all about credibility. It's different from DM, but it's also much less worrisome than we've ever seen in the past for emerging markets.
Well, I think that's true. And I'd also add to that, I think on the topic that James brought up around structural changes that were perhaps happening pre-pandemic and that we might see reasserting themselves, we did have a persistent deflationary effect from trade integration over the last few decades that took a bit of a pause during the pandemic and the Trump trade wars. That said, the degree to which trade has come down is actually very small when set in the context of a couple decades. And we've seen supply chains respond very nimbly, both to the pandemic in many places and to those Trump tariffs. And locally and domestically, we've also seen in many economies as second and third waves of the pandemic came through and new public health restrictions were put in, the real economy was dented progressively less and less by those restrictions. As James noted, suppliers and companies learn to respond more nimbly. So, while the story about technology, as Robert Solow said, can always be overdone, we have seen some accompanying structural shifts with more nimble, more remote-based working that could add to productivity over the next few years and provide some downward pressure on prices. And trade has not been so substantially impaired that some of the effect on prices that's exerted in the past won't start to reassert itself again.
Let's talk a little bit about the demand side, as I do think we've focused quite a bit on the supply side of things. I mean, clearly things are pretty different, particularly in this post-crisis recovery relative to the 2009 post-crisis recovery. Households are in significantly better shape. Cash on the sidelines is gigantic. The federal government's fiscal spending is obviously on fire. Not here in the United States, but in general, fiscal bodies seem to be much more engaged in trying to stimulate growth. I'm curious if these impacts in your mind can ultimately lead to inflation shift.
I think the impact of a lot of the fiscal stimulus that we've had is going to be limited because a lot of the money is in the wrong places. So the money is basically with people who are not spending money. They are saving money and they're investing in assets. So we see the asset inflation, but we're not really seeing, I would say, growth in spending and expenditures that you would expect with this amount of money pumped into the economy, because a lot of people that got that money, whether people or companies, maybe didn't need that much of it, and a lot of it is going into assets.
I agree that demand is just absolutely on fire in the United States and is gaining steam in the rest of the world as well. But when I think about the demand side of the economy, the bigger question, the one I really struggle with, is where is demand going to be in, say, mid-2022? As some of the fiscal stimulus rolls off, as people are kind of back into the normal, the buzz from the, we're leaving quarantine and we've been vaccinated, that kind of ends. How strong is spending going to be at that point? And could we see a place or an outcome where actually the consumer side of the economy, the demand side of the economy is softer, and that ends up feeding into a disinflationary process?
I absolutely agree with Nathan that a lot of the fiscal spending, the fiscal impulse will start to disappear, and a lot of the consumer demand fed by the high savings rate will all start to disappear. The one thing that doesn't seem to want to disappear is the huge amount of liquidity being pumped out into the economy by the central bank, not just the Fed, ECB, BOJ, you name them, they're all pumping. And with all that liquidity out there, the Fed itself has also embarked on a monetary policy, which I think once could entrench inflation, because it's not necessarily maximum growth, which is its mandated target, but it's the distribution of maximum growth, which is supposed to be to all of the people who are left out of the recoveries in the past. So if the Fed really does target the distribution of maximum employment before it starts to worry about inflation, that alone will entrench inflation, because the amount of liquidity will stay out there, and whether it's asset price inflation in housing and or crypto or whatever you want as an asset, that's the source of inflation that won't be shut down unless the Fed really comes back to a target where blunt monetary policy can be effective, and we leave to fiscal policy the job of distributing the gains of employment to those who were always left out before.
My expectation for 2022 is that consumer spending normalizes. I don't see it going down dramatically, but let's face it. I mean, we have elevated household savings. We have pent up demand after being sequestered for over a year. And so we are going to see consumers, and we already have started seeing consumers spend a lot more. There's a rotation going on now from goods to services. That will likely continue. But at some point in 2022, spending will normalize. Having said that, though, what I expect to have longer legs is CapEx spending. Companies have a lot of cash on balance sheets as well. They've been very, very parsimonious during the pandemic. And I think they recognize the value in some CapEx investment, especially in technology. So my expectation is that we do see an elevated level of CapEx spending. Keep in mind that that really should have begun after the 2017 tax reform package in the U.S. But again, this is a catalyst that I think we're going to see in many countries, and certainly around the developed world, where we see enhanced CapEx spending going forward. I think they recognize the value of that, and that should keep demand at a relatively high level. Not certainly at a high not causing high inflation, but I don't see us going into a disinflationary, a very significant disinflationary period.
Do you think companies will keep up CapEx spending when they know that corporate taxes are on the rise around the world, that minimum corporate taxes are being put in place? The G7 already said corporate taxes will be a tax base that we're going to use to finance government spending. So if there's any disincentive to continue CapEx at the fast speed that we had before, it's tax.
And echoing Bill, I've kind of expected as we move into 2022 that corporate investment is going to be a soft spot in the economy. They've got a lot of cash, but they also have a lot of debt. And I think many of these C-suites got the memo that the markets are expecting them to delever. And those resources are going to be used to clean up balance sheet rather than invest would be my expectation. So I'm expecting investment to be a drag on the recovery, not a tailwind.
We've got to just build on that by noting tax decreases haven't been a particular incentive or catalyst to investment in most developed economies. And by the same token, the recent agreement on putting in place a minimum tax rate may not be a significant damper on capital investment going forward. So whatever your view is cyclically on where rates and CapEx are going, I don't think tax is going to be the determinant on whether that view comes to fruition or not.
Yeah, taxes explain a real small amount of short-term movements in investment. And what explains a lot of it is last year's investment. And last year's investment was poor. And what explains a lot of it over a number of years is wage pressure, because businesses can start to substitute into wage economizing investments. So the wage pressure leads to the investment. So I think this combination of weak backward-looking investment, strong forward-looking wages does give us strong investment. Meanwhile, we're getting stronger service consumption. We're going to have weaker goods consumption. But I put all that together, and that's pretty strong industrial production, pretty strong overall growth, and for inflation, little higher, little more volatile.
If I can just jump in with a very different world of emerging markets, where we're tightening even before that, you have any discussion of that, right? We're talking, oh my goodness, dots have moved a couple of years from now, right? But our dots are already moving now. And in terms of access to financing, it is lower, right? Especially for the lower income emerging markets, where the access to exceptional concessional financing in 2020, that is no more. And if the markets do not continue sort of giving access to this markets, the fiscal spending will have to adjust. And on top of that, you have the monetary policy adjustment. Gina, you mentioned earlier also trade. In the past, it used to be the trade would lift the emerging markets and help them out. So here it almost feels like, wait a second, we're not having a crisis. We're not going to have likely a repeat of taper tantrum. Inflation is much better. Inflation expectations somewhat better anchored. But it doesn't look like we're going to have any growth either. It's almost like we're looking at the DM and they're doing lovely and then having domestic demand. But is it going to spill out over to us? It's not clear at all.
I think that's a great point. And it does seem to be that a lot of the inflation risk is concentrated, at least right now, in North America, the biggest G7 economies, but even more so North America, United States, and Canada. So one of the questions that I had is there a mechanism by which the US can export inflation? North America can export inflation to the rest of the world?
As long as we're a magnet for capital around the world and the dollar stays strong and maybe even appreciates, that certainly would be a source of inflation to the rest of the world. And even though every strategist out there has spent the last decade batting down the dollar, it's also created a lot of widows with that trade. And I suspect that as often as people expect the dollar to go down, the fact that notwithstanding what Jim just said about investment in the United States, it's also the source of the world's innovation and the place where if you're going to be investing money, this is the place to invest. In an inflationary world, the typical equity strategist I hear is, with high inflation, high interest rates, the high growth companies, the high tech companies will get crushed because the discount rate goes up. Well, for crying out loud, if profit margins are sustained, and in fact, if profit margins go up with companies that have a moat around their products, Teslas and Googles, you would never expect those guys to go down, and yet those stock prices are going down. So there's a market myth that seems to not to defy the logic of the discount model that they're using. So to me, I would love someone to explain to me why is that companies that have a moat around them that are able to preserve and even expand profit margins are not able to survive in an inflationary world. And so I think the exporting of inflation from the US is really going to come through the dollar, but it's going to be opposed by the forces of capital flows coming in, wanting to invest in the US because this is the place for innovation.
Well, there's another type of innovation that can export inflation, and that's policy innovation. And on the fiscal side, our policy innovation was to pay the household sector much more than it would have gotten paid collectively had we not had a pandemic. And arguably, Canada did that in 2020. Brazil did that in 2020. You got in 2021, and now that first place race car has moved way ahead of everyone else. And that's why we're talking about U.S. inflation. But I mean, between average inflation targeting, full and inclusive full employment as our two central bank objectives, and fiscal policy which writes checks and pays the household sector in a crisis more than they would have otherwise been paid, those are some pretty good policy innovations which may teach the world to get a little higher inflation going forward.
Well, I'd say the rest of the world is certainly affected by the G1, but it doesn't sit there passively taking it. Of course, the Bank of Canada and the Bank of England are already moving, on making monetary policy less accommodative. As Elina pointed out, you have a very front-loaded hiking cycle happening from the Copom in Brazil right now. So, while inflation might be exported by some of the innovations that James mentioned, it's not just being passively received. Other markets, both in the G10 and EM space, are reacting and getting ahead of the G1 in some ways. And I would note, amongst the big expansion in inflation targeting across the world that Elina mentioned, you do have a number of central banks that, rather than moving to average targets, are simply underscoring the symmetry of the targets that they've consistently undershot in the past. So some of those innovations aren't really needed to either ensure there's a recovery in place or ensure that we get sustained inflation around the kind of 2% targets that are typical. They're actually just an implementation of the policy they've said they've always had in place.
Another angle on this very interesting question of whether the U.S. could, in some sense, export inflation is when I look around the world, the common feature of the inflation process that I see in various countries is a really marked run-up in PPI prices. And I think a number of countries are seeing intensified PPI inflation. And to the extent that the gangbusters US recovery is driving up, let's say, chip prices around the world or commodity prices around the world, I think that's going into the PPIs. But what is notable is that in the rest of the world, in many countries, domestic demand just is not yet strong enough to allow the firms to be able to pass that through into consumer prices. The United States were an exception where there is enough strength. But to date, I would say it's been, to the extent that we've exported inflation from the United States, it's been in producer prices, but largely have not yet been able to pass them through into the consumers' prices.
Actually, Nathan, on that example, China is a great example of exactly what you're talking about. China's factory prices rise about 9% a year, but their consumer prices are 1.3 to 1.8% a year. So you see that China itself served as a buffer that stopped the inflation process because the companies themselves absorbed some of the price increases, they became more productive, and the consumers themselves would not go for the higher prices. So I think all of those forces within the largest emerging market out there is a good example of why it is that the fear of inflation at the producer and input level does not necessarily translate into final demand prices.
One obvious question I think we want to address is, in this inflation landscape, how should we be positioning portfolios?
Yeah, that's the question I asked earlier. Why are these growth companies getting crushed by high inflation when their profit margins are sustained or increasing? Someone explained that. I missed that finance lecture.
Yeah, well, I have some explanation for why tech companies are underperforming. It has very little to do with inflation. It has much more to do with the fact that they were remarkably successful last year, driving valuation levels to several standard deviations beyond long-term average. And much of this year has been about just a normalization of that imbalance where there were just extraordinary concentration in those names, but it has very little to do with inflation. I think it's more about a short-term rotation into cyclical stocks. That said, it's not really an inflation argument in my mind for why tech is underperforming. It's more other things are tied to an inflationary cycle or a reinflationary cycle, and at the same time, tech is suffering from extraordinary success over the last year. But I am curious if anyone on the panel would be considering adding crypto or some other form of real asset, some alternative currency. Where should we be headed over the next decade to prepare for maybe not a long-term great inflation, but if James is correct, potentially stronger pace of inflation than we became accustomed to over the course of the last 10 years?
I think, the typical ways in which portfolio decisions and asset allocation respond to cyclical developments like the one we're seeing here are already well known. I think the question is, where is relative value in pricing? For instance, tips are relatively expensive already, but you could play the same kind of inflation hedge through financial sector stocks where spreads, offer potentially bigger profit margins and prices aren't quite so rich. I think one has to tiptoe carefully around relative valuations at this stage because the playbook is already well known, and search for parts of that playbook that offer stronger relative value than others.
So I would just add, when it comes to cryptocurrencies, I think it's very, very important for investors to do their homework. Anyone who's considering a cryptocurrency investment needs to understand the lay of the land. There are so many differences between the very different cryptocurrencies out there, more being created every day. It is far more volatile than any other standard investment or traditional investment, it's arguably even more volatile than the meme stocks, although I haven't actually compared volatility, maybe around the same, maybe have the same cohort of investors. But the reality is there are some people who will look at and assess cryptocurrencies and still believe it's suitable for their portfolio. I would just suggest that one, if they feel strongly about cryptocurrencies as an addition to a portfolio, that they limit their exposure to cryptocurrencies. And again, don't assume that it will provide things like diversification benefits. What we saw was pretty low correlation historically between Bitcoin and the stock market. But if you look at 2020, when the investor base in Bitcoin became more mainstream, that was a period when correlations were much higher than, for example, gold's correlation to the S&P 500. So just think everyone should be doing their research before they invest and really understand what they're getting, that risk reward profile that comes with each individual cryptocurrency. They may be better off being well diversified if they do want exposure to cryptos. Gina, to your other question, what do you do in an inflationary environment with your portfolio? Well, I think you stay the course, especially ensuring that you have adequate exposure to stocks. Because unless we get into a very high inflation environment, stocks tend to perform relatively well in this environment. So I think we want to maintain exposure there, but we be well diversified. But it's important to have broad fixed income exposure. To Brett's point, I think tips are an important part of a fixed income portfolio, especially when we're concerned about inflation. And then, of course, there are alternatives that have had some history of hedging against inflation. I'd point to gold as something that at times, at some periods of inflation, gold has provided an adequate hedge. At other times, it hasn't. So again, I think understanding that history of performance in previous inflationary periods is very valuable, but we want to maintain diversification and maintain exposure to equities.
Yeah, I mean, if we go into this slightly higher inflation environment, we kind of skipped a step because monetary policy is going to tighten, and that's going to have some implications as well for asset markets. I agree largely with what Kristina said. I don't think higher inflation is a huge threat to equities necessarily, to property either. I wonder whether rising house prices is forecasting future rising rents, and I think structural factors and demographics could answer that question later on. But we're going to go through a temporary period where tightening monetary policy is going to create some volatility. And so thinking about how to navigate that temporary period where maybe some of the froth is taken out versus having a longer term asset allocation in maybe a world, I think, with better revenues, tighter margins, slightly higher rates, a little more cyclical volatility is, I think, a macro environment that kind of works with a well-diversified portfolio that isn't too afraid of stocks.
And following on that, for me, the question is, what's going on with growth as inflation is rising? Is it a strong growth environment as well, which I'd characterize as reflationary, or is growth weak and we're dealing with a stagflationary environment? If it's a reflationary environment, then broadly speaking, I'd be bullish risk, including in emerging markets. And I'd be interested to hear what Elina thinks about that. If it's stagflationary environment, then I think that, at least until that passes, we have little choice other than to hunker down. And tips and staying at the short end of the curve and so forth could very well be the right solution. But if we have higher inflation, hopefully it will come in the context of stronger investment and it will be reflationary.
I think it's important for emerging markets, as Nathan said, where it's coming from, because the situation we have a stagflation and pick up inflation and Fed is supposed to respond, it's not only that you have to completely change your portfolio and probably move away largely from emerging markets, it also will be a very painful reallocation because the structure of the markets has changed a lot over the last 20 years. There is a price on Bloomberg, but it's oftentimes imaginary price, and we pretend it's there, but then it has a very discontinuous effect as soon as you try to put a ticket through. It's very different to 30 years ago when you had to call and then get a price, but in a way it's similar. So there is a bit of an illusion, and I think will be a very painful adjustment process when we try to push through huge billions and trillions of dollars that are allocated to emerging markets, trying to move the dial on that and remove the allocation. That will be something very dramatic for some emerging markets. They don't have deep domestic liquid markets. I think that's where always the problem comes from. If your share of total financial assets to GDP is 11%, and maybe Argentina, you are very exposed to the global winds. If your share is 250, like South Africa or Brazil is smaller, but still you can have irresponsible, somewhat less responsible fiscal policies, and the bumblebee still flies, which in theory is too big for the flapping wings.
Yeah, and just to jump in on the assets discussion, I think another asset that that's been very volatile this past year is property, and I think the death of cities was greatly exaggerated, and we've really seen amazing increases in home prices. Some of it was pandemic effect, but a lot of the fundamentals that are supporting the housing market, for example, were in place before the coronavirus hit, and a lot of it is demographic. So I think housing and property in general is something that has a place in a portfolio. I think housing probably does well. I don't want to say regardless of the inflation environment, but I think its fundamentals are outside of some of the causes and results of the risks of inflation, right? Obviously we could get higher rates, and that will put some dampening on the housing market, but I think still the demographic drivers are pretty strong. And as an investor, now you no longer have to go out and buy a whole house. There's all kinds of ways to fractionally invest in property and other types of real assets. So I think that's something, certainly to consider. If you're concerned about inflation, I would suspect that, property, particularly housing, probably still outpaces it.
Can I get back?
Oh, William, I think you're still muted there. There we go.
Any better? Okay, great. The traditional reason for going to emerging markets is because they had outsized returns. And in the past, emerging markets were able to give us that outsized return because they monopolized part of the supply chain. They were able to be specialists in producing stuff, whether it's electronics or commodities or what have you. Right now, with the move toward decentralizing the sources of the supply chain, getting them closer to domestic markets, taking them away from emerging markets and using technology to boost domestic productivity, do we still have the same reason to go into emerging markets? Because outside of a large emerging market like a Brazil or a China, where there's a huge domestic middle class market to exploit, where are the outsized gains going to be coming from? And just let me mention about the housing issue. I would love to be able to say housing is a great investment and asset allocation should go there. But we have a political environment where if you're a landlord, the chances of collecting rent have become less and less. And your ability to be gaining the kind of returns that you had in the past have also become less and less. So the political environment has made housing less attractive, and the logistics environment and maybe political environment as well has also caused emerging markets to be less attractive. Can someone comment on those trends, whether they are substantive or whether I'm just imagining this stuff?
Well, I think on the first point, on the case for emerging markets, the difference in yield that you require to be in EMs is obviously a lot smaller than it was previously when rates were higher in the past. So there still is substantial pickup on financial assets in emerging markets. I think over the longer term, the case for emerging markets has just become stronger and stronger. And I'll pass things to Elina on this, but when we look across our footprint in the Americas and in Asia, expanding middle classes, very young demographics, parts of the economy that are still very unpenetrated by Modern financial services, for instance, offer enormous amounts of upside from both a macro and a micro perspective. And I think that's mirrored in much of the work that the IIF has been doing too.
And I think also the type of flows matters. You know, you will have emerging markets that are beginning to graduate into the developed markets, whatever the blurry, you know, the line is there. And we have seen emerging markets do QE and other sort of something that is more typical for DM. And you have more emerging markets even talking about reducing the target. But then you also have more sort of so-called frontier economies with less deep financial markets. And in some cases there, project finance, more direct banking finance are the more appropriate instruments than just relying on the global financial markets and access via bonds. So the composition of global flows, the types of financing also matters. We don't need to talk only about fixed income portfolio flow. We have other types of flow that are going to emerging markets, and we shouldn't forget about that.
Yeah, and if I could just, I guess, touch briefly on the rental question. You know, if you look at data that tracks on-time rental payments, before the pandemic, it was running around 81%. And then most recent data is running around 78%. So there's been a slight drop off there, but nothing significant. And I think one of the interesting things is, you know, in terms of politics and government, I guess, action and maybe interference, what the government has actually done, I think, through the pandemic is show that they're willing to do things to ensure that people are able to pay their rents and landlords get paid because they want to ensure that people can stay in their houses. So I think it's the changes that we've seen around, you know, what the government is doing for or against landlords, at least on the federal level, are not clear cut to me that it's a positive or a negative. There's been a lot of local actions that I think are less friendly to landlords, but the federal government is basically stepping in with payments to landlords.
And William, if I may, it's impossible to be a Canadian on a panel like this and not talk about housing, because our major cities are often identified as places where housing costs have gone up substantially over the last decade, and froth in those markets is often cited as a potential for correction. It's worth noting that in the midst of this, unsold new and resale inventory is at the lowest level that's been at for Canada as a whole, and in the Toronto and Vancouver markets, for instance, in 20 years. So, you know, there's some real fundamentals, as Tendayi mentioned, driving some of these price performances that we're seeing across big G10 countries too.
And by the way, don't think the rental inflation subcomponents of all our inflation indices capture these things in a particularly accurate or real-time way, which is again why I wonder whether high house prices and tight housing markets could be forecasting future rental price, actual or even measured inflation. I don't know if anyone.
Last question. I do have a quick question, if everyone doesn't mind, and that is, could we attribute the portfolio adjustments that are being made today, where investors seem to be much more interested in real assets, rotating out of stocks or out of bonds and into stocks? Are they strong enough to suggest that investors are more permanently embedding a stronger pace of inflation expectation? And this in and of itself could lead to a behavioral shift of anticipating higher prices, which then of course becomes something more of a spiral? Or are we too early in the cycle to really make that sort of assumption?
Let me give you a prosaic answer to your very penetrating question. And I think the first thing that springs to my mind is that measures of break-even inflation, and particularly the five-year forward that the Federal Reserve follows very closely, are still very tame. And indeed, coming out of the recent FOMC meeting, declined further. And so that is not consistent with the hypothesis that investors are worried about some kind of permanent change in inflation. Now, that said, the 5-year, the nearer term inflation expectations are higher than they are out the curve. And I think that, you know, maybe investors are hunkering down for a transitory, and let's say it's transitory with a capital T, somewhat long-lived episode of inflation, but they don't seem to be positioning in a way that suggests they think it's going to be permanent.
So if I could just add in here, we've already seen lumber prices go up and come down. And I really do believe that for the most part, investors are following where the economy is going to a certain extent. And so my expectation is that as we see that rotation continue from goods to services, that we'll see some investing shifts along with it. So to succinctly answer your question, I don't think so.
I think it depends a little bit on what's an investor. Your LDI pension fund, your bank with its hold to maturity book, they're the ones buying a lot of the most inflation insensitive bond assets right now, not your ordinary guy on the street.
But they're most at risk, right? So that would definitely make sense.
Well, I think I'm afraid we have to cut it off there, but it was wonderful to interact with all of you. Thank you so much to all of our panelists for joining us today and sharing your very valuable views. Thank you for our guests for tuning in. Enjoy the rest of the conference. Have a good afternoon, good evening, and thank you.
Thank you.